Imagine this. Every single month, like clockwork, money shows up in your account. Not from your job, not from a side hustle, but simply because you own the right investments. That's the power of monthly dividends. Instead of waiting every 3 months like most dividend stocks, certain ETFs and REITs pay investors every single month. It feels like having a second paycheck, one that works while you sleep. In this video, I'll break down what monthly dividends are and how they work, the difference between ETFs that generate income with strategies like covered calls and REITs that pay out real estate income. In addition, we'll cover some popular monthly players like JEPQ and Realty Income. In addition, we'll cover how much you can realistically earn, as well as helping you get started. Whether you're looking to cover a bill, boost your savings, or eventually build a steady income stream for retirement, monthly dividends are a tool worth understanding. So let's dive in. Let's start with the basics. What are dividends? Dividends are cash payments companies or funds distribute to shareholders from their profits. Most investments pay quarterly, but a select few pay monthly, which make them attractive for consistent cash flow. Let's go over a few examples of monthly dividend payers and how they pay out those dividends. Let's start with ETFs, or exchange-traded funds. A few examples of exchange-traded funds that pay out monthly dividends include JEPQ, JEPI, QYLD. These ETFs pay out monthly dividends by selling something called covered calls, which are option contracts. The premiums that from these sales help fund their monthly dividends. On the other side of the fence, we have REITs, or real estate investment trusts. REITs collect rent from properties and by law must distribute at least 90% of its taxable income to shareholders. That's why it's called a monthly dividend company. So while both ETFs and REITs can pay you monthly, ETFs often rely on covered call strategies, while REITs pay you rental income. Let's see what $25,000 in JEPQ looks like. At $25,000, we would have around 455 shares at $55 a share. JEPQ's latest annual dividend yield was around 11.2%. With $25,000 and 455 shares in JEPQ with that yield, we would earn possibly around $235 a month depending on how the ETF performs. If it maintained that pace, we would have an annual dividend yield of almost $3,000 from doing no work. Do note though, yields may fluctuate due to market conditions. Also, REITs like Realty Income usually yield around 4 to 6%, lower but steadier. Just a reminder, covered call ETFs like JEPQ or QYLD yield higher at around 8 or 12%, but do come with trade-offs. As always with investing, please be sure to conduct your due diligence, including match your investments to your risk tolerance. Understand dividends may fluctuate monthly. Review expense ratios before buying. And finally, stay active in monitoring the market. In order to get started, take these into consideration. Open a brokerage account, including Fidelity, Schwab, Vanguard, or even Robinhood. Research both monthly dividend ETFs and REITs to see which fits your strategy. Start small, and even $100 builds income. Use DRIP or dividend reinvestment plan to compound your payments. And then finally, track your monthly income. It's motivating to watch it grow over time. In closing, monthly dividend investing is about building reliable, predictable cash flow. ETFs like JEPQ or QYLD use covered calls while REITs, like Realty Income, pass on rental income. Either way, the goal is the same, creating consistent income streams. If you found this helpful, hit subscribe and let me know in the comments. Do you prefer high yield ETFs or steady REITs for monthly dividends?